Howdy everybody, welcome back to Accounting 1101. I'm Professor Martin. If you are here, that means you have made it through an entire week of accounting. So pat yourself on the back, maybe grab a Mountain Dew or some caffeine, coffee, whatever you need to get you through week 2 because we are getting right into it. In our video right now, we're going to be talking about using accounts to record transactions. Now, if you think back to week 1 and the work we did in week 1, you might remember we introduced the idea of the accounting equation. And we showed you how transactions impact the accounting equation. We said every transaction has an impact on the accounting equation. We went through all kinds of examples. I think we did maybe 7 or 8 where we plugged numbers into the accounting equation to kind of show you the effect of transactions on that accounting equation. But this is a pretty big but. If you think about a business like a Walmart or a Kroger, any kind of big business, and maybe you've shopped at one of those before and you've done the self-checkout or you've gone through the register and you put all your stuff up on the conveyor belt and they start scanning or you start scanning and beep, beep, beep. Imagine that you're just in one store and there's probably a dozen other people checking out at the store you're at. Now remember, these places have thousands of stores. We're talking millions of transactions a day. Could you imagine trying to plug all of those transactions into the accounting equation for an entire chain of stores? And that's just on the sales side, not even counting what the store had to pay their employees or the utility bills or for the inventory or any of that. That would get pretty crazy pretty quick, trying to cram all of that information into that accounting equation format that we showed you. So we're going to take it a little bit in a different direction here. We're actually going to start recording transactions, not in the accounting equation, but into the accounts that are within that accounting equation. We're going to put the account in accounting. Now, what we're going to do is we're going to take these separate accounts. Every element underneath that accounting equation is going to be its own separate record or account. The accounts are going to be designed in a way that's going to show us increases and decreases in the accounts. You remember back to the accounting equation, we were plugging transactions into it. We'd put pluses and minuses in to show whether or not things were getting added or taken away. We're throwing out the pluses and minuses. We're going to make the accounts in a way that we can look at the accounts and tell if it's going up or down by looking at it without a plus or a minus. So every account we make is going to have a title, a place to record the increases, and a place to record the decreases. And we're going to start looking at things by account instead of just plugging everything into the accounting equation. Here's our basic account format. And you look at that right there and you're like, well, my goodness, you know what? That kind of looks like a T. And you'd think that and you'd be right. It's literally called a T account. Another way that I knew that I was destined for accounting. My first name, Travis. It begins with a T. T accounts, the main way that we look at accounts in accounting. Another little fun tidbit, when I took the SAT as a young kid growing up, I scored a 1040. If you ever done taxes before, you know 1040 is the main individual tax form. I mean, I was destined to be an accountant. Those two facts combined with the fact that I am a terrible introvert and I don't like being around people. I was destined to be an accountant, right? And so here we have the basic account form. It's a T account. You'll notice it has two sides. It has a left side and a right side. We're going to put the account name on top of that. Cash, land, supplies, accounts payable. Whatever the account title is, it's going to go right there on the top. And we have a left side and we have a right side. That is our accounting format. Now, that's account format, I should say. I want to pause here for a second. You might have some kind of an idea about what debit means or what credit means. You may think, yeah, Professor Martin, I've got a debit card in my wallet and I go to the bank and they debit my account, or I've got a credit card in my purse and I charge everything onto my credit card and debit and credit. You may have some idea what that means. Whatever you think debit means, whatever you think credit means, I want you to forget it. Everything you know about the word debit, everything you know about the word credit, forget about it. I need to brainwash you with new accounting debit and credit terminology. Okay? And this is really simple. The hard part is brainwashing you to forget everything you know about debit and credit. All right? I want you to raise your left hand for me. I know, if you're sitting at home, you're watching on your phone, you're watching on your laptop, whatever, if there's people around, I don't care. Let them laugh at you. Put your left hand in the air for me. And I want you to say debit. All right? Left hand, debit. All debit means in accounting is left. Debit is the left-hand side of an account. It doesn't mean anything else. It doesn't mean up, down, sideways, back, forth. No, it means left. Debit equals left. Now I want you to raise your right hand for me. You see where I'm going with this? Raise your right hand and say credit. Credit is our right-hand side of an account. It doesn't mean up, it doesn't mean down, it doesn't mean sideways, it means right. Debit means left, credit means right. That's all it means. You'll see them abbreviated sometimes. Debit is abbreviated DR, credit is abbreviated CR. And so, wait a second, where did you get DR? Is it going to be like DB for debit? No. It comes from the word debitor, an old Latin term. So it's literally DR and CR, left and right. That's all you need to know about debit and credit. Now, the side we put a number on is going to tell us whether or not that account is going up or down. And that changes depending on the kind of an account we're dealing with. All right, so we have a T account on top, the name. We have a debit side, which is left. We have a credit side, which is right. Depending on the side the number's on, dictates whether or not that account is increasing or decreasing. So we need to learn some rules about that. So here are some rules we're going to start off with. Every transaction has to be recorded in at least two different accounts. We have to have a debit side and a credit side, right? In order for the thing to balance. So every transaction is going to have at a minimum one debit, one credit. We'll find out later on we could have 10 debits and 2 credits. Doesn't matter as long as the dollar amounts are the same on both sides. But we have to have at least at a minimum one debit, one credit. The total amounts of the debits and the total amounts of the credits have to equal. Debits equal credits. And that's another important concept. We talked about that accounting equation, assets equal liabilities plus equity. Here's another important concept. It's almost like the 10 commandments of accounting. You can think of me coming down the mountain like Moses, but instead of a stone tablet with 10 commandments of laws that we're supposed to follow, I've got accounting rules that we need to follow on my stone, okay? Number 1 was the accounting equation. Number 2, debits equal credit. All right? Debits equal credits in dollar amount. If I have $10 in debits, I got to have $10 in credits. That's the way it works. We call this double entry accounting. Doesn't mean we do the accounting twice. It literally means that we have a minimum of 2 entries, a debit and a credit. Got to make that thing balance. So how do we know what makes something go up or what makes something go down as far as an account goes? Well, we have rules behind that. And here are the rules of debit and credit for balance sheet accounts. And we're going to start making up a list of all the accounts we're looking at. Right now, we know balance sheet is asset accounts, liability accounts, and equity accounts. We've only learned a handful of them. Asset accounts, we've talked about cash, land, and supplies. Those are asset accounts. Later on, we'll talk about equipment and buildings. And we'll talk about inventory and accounts receivable. And we'll keep adding to the asset list we have. Liabilities, we mentioned accounts payable. Owner's equity, we've talked about capital. And the Clark Capital, the guy who started our little business we're working on here. So, balance sheet accounts. Assets equal liabilities plus equity. Hopefully you look at that and say, hey, that's the accounting equation. I know that. Yeah, you do. Look here. Assets equal liabilities plus equity. You'll notice assets are on the left-hand side of the accounting equation. If an account lives on the left-hand side of the accounting equation, it goes up on the left-hand side of the account. If the balance sheet account lives on the right-hand side of the accounting equation, like liability accounts and equity accounts, they go up on the right side. Okay? And so just kind of take that in for a second. If the account is located on the left-hand side of the accounting equation, if it's an asset account, it goes up on the left-hand side of the account. If an account's on the right-hand side, of the accounting equation, it goes up on the right-hand side. And of course, it would go down on the opposite side. All right? Now, it's kind of like driving a car. I've been driving a car for, 30 years now, 25 years now. I don't have to think about the gas pedal, the brake, and the clutch. I drive a manual transmission, last of a dying breed. But I don't have to think about it because I know. When you first start driving, I'm finding out with my kiddo, she has to think about what the gas and brake does. She has to think about which one she's pushing, okay? It'll be the same way for learning accounting. At first, it'll be a big struggle for you to understand, okay, I want to make an account go up. How do I do it? What do I need to do? I need to make that account go down. What do I need to do? I can't remember. You're going to have that struggle. I promise you, I have struggled with it. Everybody who takes accounting struggles with it. But eventually, if you study it enough, I promise it'll get to be like driving a car. You'll just know, oh, I have a cash account. It's an asset account. To make it go up, I need to debit that account. All right? You'll get to that point. But that's where we're going. So balance sheet accounts. Again, to summarize, on the left-hand side of the accounting equation, that account goes up on the left-hand side, the debit side. If it's on the right-hand side of the accounting equation, it goes up on the right-hand side of the account, on the credit side. Income statement accounts. We're talking revenue. We're talking expense accounts. Revenue accounts go up on the credit side. Expense accounts go up on the debit side. Just write it down. Just memorize it. If it's a revenue account, it goes up on the credit side. If it's an expense account, it goes up on the debit side. All right. So we have balance sheet accounts. We have income statement accounts. It's one or the other. Either the account lives on the balance sheet or it lives on the income statement. We put all that together. There's my accounting equation. You can see the rules. Asset accounts go up on the left. Liability and equity accounts go up on the right. Income statement accounts flow into owner's equity. Revenue goes up on the credit side. Expenses go up on the debit side. Right and left there. And they'll flow into owner's equity. We'll talk about that process later on down the road. One more thing I want to point out. You notice a little blurb down here. The side of the account for recording increases is known as the normal balance side. So the positive side of the account is the normal balance side. Why do you call it that? Well, that's normally where we would expect a balance to appear. We wouldn't expect a credit balance overall to appear in the cash account, because that would mean we have negative cash. We're overdrawn. We'd expect the balance to be positive. We wouldn't expect to have a negative amount that we owed a creditor. So the normal balance would be on the positive side. So normal balance, if you ever hear me use that terminology, all that means is the positive side of an account, the side we would expect a balance to be upon. Normal side for an asset account would be the debit side. Normal side for an owner's equity account would be the credit side. Normal balance side for revenue would be credit. Normal balance for an expense account would be a debit. Let's put it in action here. Just one example real quick. November 1, we remember Chris Clark deposited $25,000 in a bank account to start Net Solutions. We plugged that right into the accounting equation, didn't we? I just throw it under the asset side, throw it under the equity side, and we're all good. Now we're talking about putting it into the actual individual accounts with a debit or a credit. We can do that. Here's my cash account. It's on the asset side of the accounting equation. Here's my capital account. It's on the equity side of the accounting equation. And so we're thinking, I need to make cash go up. The business is getting cash. If I'm on the left-hand side of the accounting equation with a balance sheet account, it goes up on the left-hand side, right? There's the rule. If I'm on the right-hand side of the accounting equation, the account goes up on the right. So I'm going to plug $25,000 into the debit side of the cash account. I'm going to plug $25,000 into the credit side of the capital account. Owner's equity goes up $25,000. Assets go up $25,000. We're in balance. Debits equal credits. Every transaction you ever do in accounting, debits in dollar amount have to equal credits in dollar amount. I got $25,000 on the debit side, left-hand side, $25,000 on the credit side. So a lot of rules to take in there. This isn't something that I expect you to learn after one try and then we just forget about it like a history exam where you learn a date and you never think of it again. No. We're going to be using the rules of debit and credit pretty much every single day from here on out in accounting. And so you're going to get a lot of practice. So don't freak out if you don't quite have it down just yet. Practice, practice, practice. Accounting is a skill. No different than shooting a free throw, throwing a softball or a baseball, baking a cake, changing oil in a car. It's a skill. The more you do it, the better you're going to get at it. So, to wrap up here, where are we going? I plugged the transaction directly into the account. Usually we don't start there. We start by journalizing the transaction and writing it out, and then we post it to the account where it goes. So in our next video, we're going to talk about that process of journalizing a transaction, writing it out in a journal, and getting it to where we're ready to post it into the account. We'll practice both of them quite a bit, I promise you. And the process of doing all that practicing, if you have any questions, I'd be happy to help. Again, my goal isn't to get everyone to get it on the first try. My goal isn't to see which one of you gets it first and then laugh at all the other people. My goal is that everybody gets it. Might take some people longer than others. That's okay. It's not a race. Our goal is to understand accounting. I don't care when it happens. I just care that it happens. If I can make it happen quicker for you, hey, reach out and let me know. I'd be happy to do that. Next video, we'll talk about journalizing those transactions. Until next time, take care, everybody.